Trump doesn't call me before he makes decisions. I built products for long-term investors. If ETH moves up or down 5 or 10% in a day, it honestly doesn't matter to me. I care about what ETH does over the next 5, 10, 20, and 100 years.
DeFi is pretty overcrowded. So why should anyone care about Plaza when there's other yield generating opportunities out there and perhaps even some more juicy ones?
I'll push back against the more juicy ones because I think the price discovery of Bondi makes it trade such that it is always an attractive yield relative to other opportunities in the market.
I'm here with Ryan Galvankar, who's founder at Plaza. Plaza is a platform for on-chain bonds and leverage on Base, and also Interop Ventures Portco. And today we're going to be chatting about Plaza, which just recently launched Mainnet. We're going to be talking about the bond market for staked ETH assets, as well as leverage ETH, and their recent launch, which is really exciting. There's some interesting developments there. We'll talk about institutional adoption, I suppose, and also perhaps what's happening in the global markets right now. Hey, Ryan.
Hey, thanks for having me. Happy to be here.
Yeah, it's great to finally get you on. It's been a long time coming, and congrats on the recent launch.
Thank you.
How's everything going since then?
It's been going great. Our user base is entirely retail and organic, and we are growing deposits at around 5% a day. So we're quite excited that it seems like Plaza and our products are resounding with the market that we wanted to help and build for, which is regular people who want to invest over the medium to long term in high quality, sustainable assets. So excited to see like early signs of product market fit and excited to accelerate on the growth.
Yeah, and it's really quite impressive that you're growing at 5% a day, even especially given what's happening now with crypto markets. I think ETH is flirting with 1,700 right now. We're recording this on April 3rd. This is the day after the Trump tariff announcement, or actually the Trump tariffs went into effect. What's your outlook on the markets right now? You know, I guess maybe in the short term, but also in the longer to medium term time horizon.
Yeah. I can give you my takes on like where I think the market is going to go, but my broader take is short-term vol doesn't matter. I built products for long-term investors. I think the people that have done best in crypto and the broader financial markets are people who take high conviction bets over a long time horizon. If ETH moves up or down 5 or 10% in a day, it honestly doesn't matter to me. I care about what ETH does over the next 5, 10, 20, and 100 years, and I just buy more continuous and hold it. So I'm quite bullish on ETH. There's really smart people building on Ethereum. I think ETH as an asset has the potential to accrue a lot of value through kind of rollups making transactions cheaper, and then rollups ultimately paying the base layer and that accruing to ETH as an asset. ETH is still the most dominant DeFi used asset. So ETH-based DeFi protocols, call them Aave, Morpho, Pendle, still have way more TVL than any Bitcoin-based protocols or Solana-based protocols. So I'm quite bullish on ETH in the long run. In the short term, looking at the wave of tariffs from the Trump administration, looking at general crypto vol as people move between ETH, Solana, Bitcoin, meme coins, I think it's going to be choppy for some time. I think one thing that helps is hopefully we get some really good regulatory clarity in the US over the next 6 months, which is one bullish for crypto because it unlocks kind of the the retail market of the largest capital market in the world, which is the US, coming on chain in a material way, and projects being able to market to them, be based in the US, do things around the US. I think that'll bring a lot more capital into crypto. But until then, like Bitcoin, Ethereum are essentially macro products. They trade with interest rates and kind of the opportunity cost of investing in other things in traditional finance. So when there's volatility in traditional finance, there's volatility in crypto, and I don't expect that to change for the next few months.
I mean, that is an interesting take. I guess I would maybe challenge the long term that like long term investors are have done well or like better than short-term investors, because like if you look at the top, say like 10 coins, if you had been holding ETH for the last 4 years, you'd be exactly where you started. If you'd been holding Solana, you'd be down. I think like maybe you would have made money if you're holding Tron and XRP. Yeah, so I mean, like ETH holders have not been rewarded for being long-term holders, at least in the last 4 years.
Yeah, but I view 4 years as medium term. And if you look at like the bond market, what is classified as like a medium term bond is like anywhere between 2 years and 10 years. Like long term is like 10 years. And if you held ETH from I guess like longer than 4 years out, like let's say 6 or 7 years, you've done extraordinarily well. And if you held Bitcoin early, you've done extraordinary well. Like if you look at 4 years back, you're like comparing kind of like top to what I'll call now as like a midpoint. So like yeah, the returns don't look great, but if you think about like the percentage of the world that's on chain today versus potentially could be, then it's pretty clear to me that like if the world moves on chain, like ETH will be substantially higher, like orders of magnitude. And until then, it's like not really like in my interest to worry about like the short term swings because I have conviction that like that world is going to happen as people kind of understand why decentralization matters, why you want transaction systems, why you don't need to trust governments and institutions, and why that's better for you as a user, and why we can build more efficient systems on decentralized systems. So yeah, I think 4 years is not the long term, and I think we're playing for something bigger and longer than that.
Yeah, I mean that resonates with me. I guess like, do you think that the cycle is over? Do you think that we're now in a sustained bear market? Or do you think that, as I think a lot of people were predicting, or at least considering, and including myself in the last 6 months, that, we would see the top of the super cycle sometime in 2025, 2026, and that sort of like lined up with a lot of the previous cycles? It feels now like maybe there's a chance that doesn't happen, especially given just the overwhelming interest for Bitcoin from institutions, the lack of interest for ETH and altcoins generally, as well as the geopolitical situation and sort of economic, global macro situation with tariffs, war, interest rates, etc. And this is a little bit sort of like beyond my kind of like understanding of markets, but I've heard a lot of people talking about this like 18-year cycle theory thing, that like we're coming to the end of that 18-year cycle with regards to the S&P 500, and that it's all downhill from now, basically, that we're going to like enter a huge recession in the next little while. So like all those things put together, what is the case for a mega bull market that brings everything back up, including altcoins, in the next 12 to 18 months?
Yeah. Um, so I I think cycles are a thing with an asterisk. I think there are repeated patterns in human behavior and market psychology that lead to cycles, but I don't think cycles are this like set in stone thing that we are following the cycle and have no way out. So the answer is an unsatisfying one, which is it depends, and it depends on a lot of different things. The bull case right now is that there's a lot of institutional interest in coming on chain. Like big institutions like BlackRock and Fidelity are legitimately exploring how they can leverage blockchain rails to do things like stable coins, asset issuance, keeping track of kind of customer positions, custodying assets. All of these things are like rapidly accelerating, which is a really strong positive catalyst for more capital flowing on chain and more capital flowing into assets that are not Bitcoin. At the same time, another positive tailwind is the potential for more regulatory clarity and more retail investors from the US coming on chain. And then the headwind is all macro. So it's high interest rates, high inflation, which makes the opportunity cost of holding an asset that pays zero yield, which is like Bitcoin or Ethereum, quite high when you can own a treasury bill that pays you 4.5%. Macro at times is a headwind and at times is a tailwind. In 2021, when crypto ripped, there were massive rate cuts, huge amounts of money printing, and the policy direction of the US and other countries is going to determine whether macro remains a headwind or it becomes a tailwind. So that's a little bit tough for me to predict. Trump doesn't call me before he makes decisions, so I'm sitting on the sidelines just observing. And the types of bets I like to make are over long horizons where they're based on fundamentals like, hey, there's like really interesting technology here that adds value to institutions, and that's why institutions will come on chain, which is why I'm building in this space. And I think that there is already quite a big base of people around the world that are excited about decentralization and demand decentralization that will sustain the business regardless of like market cycles. So that's my hedged bet. It depends on macro. There's a lot of things to be bullish on. There's some things to be bearish on, and we'll see where it shakes out in a few months.
So let's dive into this institutional adoption. Where do you think the most interest from institutions is coming from? Is it stablecoins? Is it RWAs? Is it sort of building things on chain? Is it building app chains? What do you see, and perhaps like what do you anticipate will be the catalyst that really brings institutions on chain in the next year? Because I feel like, maybe just taking a step back here, institutions have been coming for a long time. Back in 2015, 16, 17, folks will remember there was this whole era of permission blockchains when everybody in the space was trying to build blockchains without Bitcoin. Now I think things are different now because there's more of an understanding of what blockchains are, their security model, the sort of threat model, but also there's just like assets that weren't available back then. Like, stablecoins, I think, have done a lot to show institutions how they can use blockchain to improve things like transaction settlement, right? Like very basic things. But I happen to know that you think that it takes more than just cool tech for institutions to come online. So share a little bit about your thoughts there.
Yeah. Institutions only do things when the potential profit drastically outweighs the cost of getting involved and the risk. So right now it's pretty clear to me that like stable coins are like the first hammer to fall. Stable coins have clear product market fit for people making cross-border payments. You get instant settlement. You can send money with like a fraction of a penny in fees, where the alternative in traditional finance is like wait 2 days and send a $25 wire, and then you have to call like 5 times to make sure that the wire actually goes through. So for things like remittance payments and things like that, stable coins are clearly gaining huge amounts of market share. And banks see that. And I think one of the things that they're worried about is people self-custodying stablecoins and no longer depositing in a bank, because that kind of breaks this whole like process where banks use that deposited capital to go make loans. So banks are trying to figure out ways to support stablecoins. It adds value to their users by giving them a better UX of fast and instant payments that are cheap, and users are demanding it. The next piece where we're starting to see some like early interest is one in holding Bitcoin, simply because it's now crossed this threshold in market cap where it's an investable asset from an institutional perspective. There's enough economic security behind it and kind of ability to absorb large purchases without materially moving the price, that it is now just like an asset that's uncorrelated to the other things that institutions have in their portfolio. So they're like starting to allocate to it. The asset has also done really well. So institutions feel like they're like maybe FOMOing a bit, but um, the on top of that, RWAs are interesting. Institutions are always looking for a new buyer base for assets because that improves kind of the efficiency of markets. More people trading a thing equals more efficient price discovery. So in a lot of these like assets that are getting tokenized, tend to be like real estate in like emerging countries because like that is easy to put on chain from a regulatory perspective. I think with the regulatory shift in the US, you'll start to see like more high quality developed market assets that people are excited to own. And the reason for that is it opens up a broader base of people who can buy those assets. And hopefully those assets become more liquid and trade at a higher price because there's just a broader buyer base. I think that one, like RWAs coming on chain in a meaningful way, is a little bit of a chicken and egg problem. It's like, do the assets come first or do the buyers come first? Because no one will put the RWA on chain unless there's like a significant buyer on chain. And at the same time, the buyers don't come on chain until there is a significant asset coming on chain. And that's why I think like approaches like BlackRock's approach of putting assets on chain and then matching that with capital is like the right way to bootstrap the market because they're bringing their own capital to be the buyer and their own assets. So they're basically viewing like the blockchain as a good way to custody this asset and justify the investment in building the infrastructure for a broader play. So I think that'll be like a good way that RWAs come on chain. For altcoins, alt L1s, things like that, I think it's really going to come down to where the users are. I think institutions will support chains and assets where there's significant retail flows because it's essentially their customers demanding it and voting with their dollars that those institutions should service them on those platforms and with those assets. So I think for that, that's a little bit of a longer time horizon, and it's going to depend on kind of retail flows.
Yeah. Do you subscribe to this idea that, I guess, like, maybe my take on the institutional part is that there's a real sort of use case for Bitcoin and stablecoins, but institutions have not yet really understood. And this kind of ties into the decentralization thing that we were talking about before the show, which is that the infrastructure that we're building kind of serves a purpose that institutions don't really find that appealing or useful, which is speculation and also to some extent, tax avoidance and avoiding the traditional finance system altogether. I think like there is, a truly political project that exists in Bitcoin and by extension in DeFi. Now that has been stretched to like, absurd, sort of like absurd use cases like meme coins and things like that, right? Like totally exiting the system. And that counterculture movement, I guess, if you want to call it that way, for folks that are building in that space, that are really sort of passionate and have, for a long time wanted to uproot the traditional financial system with crypto, like having to become buttoned up and going towards institutions, regulation, and compliance is really counter to their entire vision of the world. And I think that is also some of the pain that founders are feeling now, and also perhaps why my altcoins are not performing so well, because institutions have shown interest in things like Bitcoin and stablecoin and RWAs, but not so much in the social casino. So yeah, what are your thoughts on that?
I think that's right. I think like it's hard for institutions to wrap their head around decentralization because the main thing that you are cutting out with decentralization is
Is the
institutional
institutions.
middlemen that provide trust, right? So like I personally trust institutions like BlackRock and Fidelity because they're highly regulated. I'm an American. I used to work in traditional finance. I think there are a lot of problems with these institutions.
I mean, sorry, but there, you trust the regulation will come and save you if the institution acts badly. But the institution, I mean, the trust that you have in that institution is reliant on that regulation being there and being effective.
Yes, exactly. I think there's two things. There's both the regulatory trust building, meaning that if one of these institutions did something really bad to me, the regulator would step in and the cost of doing something bad to me and other customers is too high for them to justify doing it. And I also think that a lot of these institutions, the reason why they have succeeded and achieved such tremendous scale is because they value their brand So there's this like social contract between them and their customers that if they do something bad to their customers, that will lead to a mass outflow of customers. Like there's competition. You don't have to work with companies that you don't want to. So these institutions not only have this like regulatory hammer, but they have this like social hammer that like if their customers revolt, like they won't be in business anymore. So both of these factors to me keep these institutions within a playing field that like I feel okay as an American. That being said, you can unlock a lot of efficiency and even greater degree of trust by cutting out these institutions altogether. And if you are a large institution, you feel better about the fact that like this other institution who you work with and who you sign a legal agreement is like the one custodying assets, and like that's how you've done business for centuries. So this idea where like you don't trust anyone but code is like a little bit foreign to them and is cutting out like businesses like theirs from this system. From the earliest days of like this blockchain revolution, the earliest adopters and the people pushing it into existence were like the people that do not trust these institutions at all and are like, I guess, like fighting against the man to build these systems.
The
And
cypherpunk.
it's not from the institutional side the other way around. Like BlackRock isn't going to volunteer to forfeit their business. So to a larger extent, I think like the way that altcoins, alt L1s, all these things get to the scale where they're at Bitcoin and they're starting to work with institutions to hit that next leg of growth, you have to like win over the people. You have to convince people that like this is better for them in some way. And I think we're not yet there on Ethereum is almost there. They're not there. Solana's almost there, they're not there, and then everyone else is like miles away. So until they get closer to that, it's hard to see institutions bowing to, oh, like users are demanding this, we have to service these things.
Yeah, I think the next shoe to drop, maybe not yet, but at some point, the new institutions that are being formed now that are acting at the intersection between real world assets and blockchains, i.e., the asset issuers, I think at some point will also be cut out, right? Because why do I need an asset issuer to issue like a bond on chain when the US government could issue that bond directly on chain? Now, like there's structural sort of market, there's things that structurally like the market would need to change and regulation would need to change, and sort of understanding and adoption of these technologies would need to grow tremendously for that to happen. But it's not impossible for these real world assets to exist on chain. Title, like land title registry, like DTCC type activities could exist on chain, and those intermediaries would also be phased out. Now, these are, I guess, crypto native intermediaries today, or intermediaries like companies like BlackRock that are at the forefront, but a lot of like crypto companies, quote unquote, right, that are like building these businesses at some point, I believe, should also not be necessary, if governments and I guess like consortiums in the case of the DTCC or other things like that start issuing assets directly on chain.
100% agree. And this is why Plaza chose to build what we're building. So I fundamentally believe asset issuers are like the worst middlemen that exist in the financial system that have a massive grift. The people that bring the most value to the table in a financial system are the asset originators or owners and the bidders of assets. It's not the people that sit in between and package these things really nicely, but that is where a ton of value is captured. That is the whole business of Wall Street. And essentially, like you can think of it as, let's say you're like a consumer lender. The fact that you found a customer and took the risk and made a loan is the value point. The process of packaging those loans, another value point is being able to provide capital to buy those loans so the asset originator can make more loans. The value point is not the fact that Goldman Sachs bundled these loans together and issued a securitization. Yet Goldman charges 10 million in fees and ongoing servicing costs for supporting these structures and kind of enabling this market. In a world of blockchains, like if the asset originator brings these assets to the market and the market can freely bid on them, and there's permissionless infrastructure that allows you to create these interesting structures, which is what Plaza is, then the people who get paid for these two things are either the asset originator or the asset buyer, and it's not the structure in between.
All right, well, let's talk about Plaza. What are you guys building?
Yeah. So we're a platform for programmable derivatives. It's a fancy phrase that we made up that essentially captures that we're building tokenized structures on top of vaults. So essentially assets sit in a vault. We create interesting structures on top of that vault that are better suited to different types of investors. Let's say a bond backed by those assets or leverage on those assets where both of those structures or any of those structures are all represented as ERC20 tokens. So they're cross-chain composable, easy to integrate with other things in the decentralized financial system. You can bridge them anywhere. But those assets at the same time are always redeemable back for the underlying asset in Plaza's vault. We're building towards more composability in the decentralized financial system and being able to provide medium to long-term investors with better assets that are more suited to their risk return profile. We're launching with two assets. One is called Bond ETH. It is a bond backed by ETH. So ETH LSTs and LRTs sit in the vault, and we issue a bond backed by that vault, and that bond pays high yield in USDC, so stable dollar income, and that bond can always be redeemed back for ETH out of that vault. On the other side of that trade which is levered ETH, which is essentially levered exposure to all the assets in the vault, where that leverage comes from essentially the fact that the vault also issued bonds to finance that leverage. So we're starting with Bond ETH and Lev ETH. In a few months, we're launching bonds and leverage backed by Bitcoin, backed by Solana, and then opening up the platform for any user to create any structure on any asset. So in the paradigm where you're an asset originator who issues loans off chain, you can tokenize those loans on chain and do a securitization through Plaza, where instead of paying Goldman a $10 million fee, you pay zero. Instead of ongoing servicing costs, you share in the fee revenue with the Plaza ecosystem. So you get paid for bringing your assets to a securitization, totally inverting this like asset structuring middleman dynamic.
So how much yield does Bond ETH pay right now, and like how much leverage can one get off of Lev ETH?
Yeah. So Bond ETH has a fixed coupon of 2.5% per quarter or 10% per year. But Bond ETH is cool in that it can find true price and yield discovery by trading freely on dexes. So there's this fixed coupon, but if the bond falls in price or goes up in price, that yield changes based on kind of the price of the asset. So Bond ETH should trade to whatever the market feels like the clearing yield is for a over collateralized position backed by whatever the underlying asset is, in this case, Ethereum. So it's going to launch at a 10% yield, and the market will decide whether 10% yield is appropriate, too much, or too little. And that's really exciting because that creates a very sustainable yield structure. On the levy side,
Wait, just one sec. Just to get this kind of yield thing correct, right? So you said it's a 2.5% per quarter, 10% per year coupon. In the docs, though, it says 2.5% USDC per bond ETH, 10 USDC per year. Is that a typo?
no, that's exactly right. So it's like
Okay.
$100, let's say, par value. So 2.5 USDC a quarter is 2.5%.
Right. Okay. So like one bond ETH generates $10 a year in a coupon.
Exactly.
Okay. Like, so, like, why would anybody hold this? Because like that's not a whole lot of yield, right? I mean, you could hold, say like other assets in the like other ETH-based or ETH-backed assets that are generating a lot more yield than that.
So I've yet to see an ETH-based yield that exceeds 10%. But the point of the asset is it'll trade to whatever the market clearing yield is for that level of risk. So the yield should always be attractive through price discovery. The reason why you hold it is because you believe that ETH will be worth something to continue to support your coupon payments. Like, how that yield is generated is partially through staking or restaking yields, and then partially through selling some of the capital appreciation of ETH. So ETH going up and you sell some of the tokens to fund the USDC coupon. So like the reason to hold it is because you want dollar income to help fight against dollar inflation. Maybe you need some higher yield than you can get from lending out ETH or lending out stables. The lending rate for ETH on Aave right now is like 2%, and the lending rate annualized, and the lending rate for stables is something like 5%. So this is like a 10% yield in a relatively stable asset backed by blue chip decentralized assets. So it's really meant to be an asset for long-term yield-seeking investors. Maybe some of these people hold stable coins because they don't trust banks or institutions, and that's where they park their money. But they're quickly realizing that, like, hey, like dollar inflation is a real thing. Like my money is worth 5% less every year. So having an asset that yields 10% but is relatively stable helps them not only like fight that inflation but grow their wealth over time, and is truly a on-chain savings product for people that don't want to trust banks, institutions, and only want decentralized assets.
So just to be clear here, one bond ETH is $100 is worth $100. So like one bond ETH is 100 USDC. It's not one ETH per bond ETH, and that's where you're getting this 10% yield on. Correct?
Exactly. So the at Genesis bond ETH is issued at 100 USDC. So right now that's like about 18 bond ETH per ETH. And then the price of bond ETH can freely float. So it can fall to 90, it can go up to 110 as the market kind of discovers what the appropriate price and yield for bond ETH is. But the where you get to the 10% yield is essentially 2.5 per quarter times four, $10 a quarter on $100 of par. So $10 for every $100 you invest per year.
And why is it $100 per bond ETH?
We chose $100 because that's kind of the par value of bonds in traditional finance. So in traditional finance, like people talk about bonds as like, okay, this is a par bond that trades at $100. Or it's a discount bond that trades at $90. And we wanted to use that same framing for this first decentralized bond so that it's more understandable to people who come from kind of the normal bond market.
And what about the leverage ETH? How does that work?
Yeah. So the leverage is market set and dynamic. So the leverage is based on how many people are creating bond ETH relative to levy. So it's going to launch with about a 3x leverage ratio. And then as people create more bond ETH because demand for bonds is higher than leverage, or vice versa, the leverage ratio will move up and down. And that product is meant for people who are long-term bulls on ETH. So people like myself who believe that 10 years from now, 20 years from now, ETH will be substantially higher than it is today, and want some leverage exposure to that ETH without risk of getting liquidated, meaning that you don't get stopped out of your trade like you would in perps if ETH falls significantly in price. I'm not worried about short-term volatility. I'm worried about what ETH is going to do over 10 to 20 years. So right now, my only option if I'm bullish on ETH is to hold ETH liquid staking tokens or liquid restaking tokens and not take on any leverage. But I'm constrained in my capital. I want more exposure to ETH. So having some leverage would be great, but that breaks if ETH falls 90% or something and I get shut out of my trade and it goes to zero, and now I no longer have any exposure to ETH. With Levy, because the leverage is dynamic, the asset should delever as market prices fall, so softening my blow, but also making sure that there's always some ETH that I'm long, even if ETH falls significantly, so that when ETH goes back up over a medium to long horizon, I'm in the game playing for it and participate in that boom.
Taking a step back and looking at the derivative space, DeFi is pretty overcrowded. So why should anyone care about Plaza when there's other yield generating opportunities out there, and perhaps even some more juicy ones?
So I'll push back against the more juicy ones because I think the price discovery of Bondi makes it trade such that it is always an attractive yield relative to other opportunities in the market. But the core value add of Plaza is any asset profile that's better suited for investors. So any profile you can imagine backed by a hard asset like ETH or BTC. So the breadth of products that can be created via Plaza is much wider and much better tailored to your specific risk return tolerances as an investor. And two, the cross-chain composable aspect. So the fact that these bonds and leverage tokens are ERC20s, always redeemable back for ETH on our platform, or bridgeable anywhere used across DeFi, that unlocks a lot of flexibility for users. So if you think about the derivative space in crypto today, almost all of the players are unfortunately quite centralized. And that's okay because users haven't seemed to demand decentralization in the derivative space. But the downside of that is if you look at perps, for example, which is the perpetual futures are the derivative with clearly the most product market fit. Hyperliquid is, I don't know, a 10 billion market cap and like 2 billion a day of trading volume. On Hyperliquid, you post collateral and you can open up a longer short on any asset, but your collateral and position are trapped on Hyperliquid. You can't take your 3x long Bitcoin and go and lend that out or borrow against it or deposit it into a strategy vault because of kind of the core structure of how perps work. They need that collateral there to slash it if Bitcoin goes down. With Lev ETH, you can be levered long ETH, or with Lev Bitcoin, you can be levered long Bitcoin, and you have an ERC20 token that you can bridge anywhere to go farm incentives on another chain, or lend out on Aave to earn some incremental yield, or integrate with a strategy vault that's taking that Lev ETH and doing something clever to generate more yield. On top of that, Hyperliquid can create perps on Lev ETH or Bond ETH. So we view the broader derivative space within crypto as a good phase one. They opened up a lot of interesting products, did a lot of interesting experimentation, but we view ourselves as phase two of DeFi. So the next big leap in architecture that enables more composability and flexibility for users to be able to do with their assets what they want. A movement back towards this decentralized Garden of Eden that was promised, where you have full freedom to move your money anywhere. So that's what we're really excited about with programmable derivatives and Bond ETH and Levy.
So when we first started talking and learning about Plaza, you guys were building this on Cosmos and you wanted to build it as an app in the Cosmos ecosystem, possibly on the hub, and then pivoted to Base, which I think was a great move for you guys. But can you talk a little bit about what pulled you away from Cosmos and what pulled you towards Base, or maybe what repelled you from Cosmos?
So this is a little bit of my arc as a founder. And so when I first got started in the decentralized financial system, I got involved because my good friends from college, Magnus and Barry, who are the founders of Skip Protocol, which is now Interchain Labs, showed me some of the cool things that you can do on chain. So we actually still share an office with Interchain Foundation. They were quite pivotal to me getting involved in the space. So naturally, we set out to build on Cosmos because our friends were building on Cosmos. I still firmly believe that the Cosmos tech stack is the best tech stack for high performance and full decentralization. We were originally building a sovereign Cosmos chain, and we were working with a few other parties to deliver some of the core infrastructure we would need to be able to deliver a seamless UX to users. So those two dependencies were, at that point in time, there was no canonical version of ETH wallet signing for Cosmos Chain. So everyone had to have their own Cosmos wallet, which Kepler is a great product, but the ask of going to a user of MetaMask or Rabi and saying, hey, you've got to download this new wallet and move funds into it was a little bit too high for us. So we were excited that someone was building a way to integrate ETH wallet signing into Cosmos chains. And the second piece was fast bridging from Ethereum, Solana, and other ecosystems to Cosmos chains. So at the point in time, which was September of last year, the best bridges were like XLR and Hyperlane, and they took about 30 minutes to bridge from Ethereum to Cosmos, which we felt like was too long. And we wanted to see a bridge that was substantially faster than that, where you can bridge in under 30 seconds like you can between an ETH-L2 to ETH-L2. Both of these things people were working on. Both of them suffered massive delays and honestly pauses because of infighting within the Cosmos ecosystem on what the right direction was. At that point in time, we were looking around and trying to understand, okay, like these pieces that help bring all this liquidity into Cosmos and open up Cosmos to new capital bases are not coming, and the current Cosmos user bases were quite small. So we felt like, okay, like we have to go where the users are, and where the users are is on Base. So we met with a bunch of different L1s and L2s to figure out where the best place to get the most distribution for Bond ETH and Lev ETH were. And we got really excited about Base's focus on UX, how they're working on bringing the world on chain, especially in the US, where Coinbase has incredible distribution. They're focused on amplifying products and their roadmap to decentralize the Base sequencer. And all these things got us really excited about a world where you can buy ETH or Bitcoin and on-ramp into Web3 through Coinbase. easily move those funds into a Web3 wallet via Coinbase wallet, and then deposit into Plaza and get exposure to better risk profiles for all without paying gas and all with a single app that flows seamlessly. And that's what we're able to deliver on Base that we couldn't do on Cosmos in September. We're still quite excited about Cosmos over the long term. So in recent months, Skip, now Interchain Labs, has taken over stewardship of the Cosmos SDK and development of the Cosmos ecosystem. So they're launching something called Eureka, which is enabling fast bridging from Ethereum to Cosmos. And we gave them a lot of interesting product feedback that helped shape the direction there. So we think that's going to unlock a lot of liquidity for Cosmos. And we know that ETH wallet signing recently launched for Cosmos chains as part of the Cosmos SDK. So both of those pain points are now solved from a developer's perspective. We're excited to see how that shapes up from a user's perspective and liquidity perspective for the Cosmos ecosystem. Plaza, by core value, believes that users should be serviced where they are, regardless of what chain or ecosystem. So our products, Bond ETH, Lev ETH, and future products on Bitcoin, Sol, and any asset are bridgeable to any ecosystem and integratable across DeFi and any ecosystem. So we are going to support Cosmos and are excited to work with the Interchain team on that. So we view ourselves as Base is the hub. Base is where we've found the most resonance with users and where we expect to find the most growth. But we will support everyone everywhere. And we are quite excited to see Cosmos now heading in the right direction.
Yeah, I think also excited to see Cosmos going in this direction. I think it's still a long ways to go until it can catch up with other ecosystems. But definitely, I think that Cosmos continues to be very well understood by people who are building great tech, understanding that it is superior to a lot of stacks in the ecosystem. And I think that the Cosmos ecosystem continues to have like great longevity and its core of, user base, token holder base, and that's something that, can't be said about some other ecosystems from, I guess, like the same, time frame, from like 2017, 2018, 19, that have like lost a lot of its users and interest.
Cosmos
Still bullish.
The fact that their tech is so good that like developers want to work on Cosmos, and like it's truly performant decentralized tech. And despite the ecosystem often shooting itself in the foot, it always comes back to the core technology. So now that Magnus and Barry and the Skip team are leading Cosmos, maybe the self harm that Cosmos has gone through over the last few years is over, and I'm super bullish now.
Same. What's your call to action to folks listening here, other than, of course, like go check out Base and deposit some ETH there to generate yield on your ETH, or leverage, depending on where you think the market's heading. Maybe both, if you're like delta neutral.
I think you should check out our docs and our testnet to explore Plaza products. So read about Bond ETH, read about Lev ETH. If it's interesting for you and you're looking for stability and yield or leverage on assets like ETH, then consider depositing in our pre-deposit program, where we're incentivizing liquidity bootstrapping. And then if you're exploring kind of how to get into Web3, I would encourage you to look at Coinbase and Coinbase Wallet. And if you're already an on-chain maxi, I would encourage you to explore some of the opportunities on Cosmos, because we think the ecosystem is really heating up, and we're excited to work with them over the next few months to bring something interesting to the table.
Ryan, thanks for coming on. It's been great chatting. Cheers.
Thanks, Ed.